Hi, in this video I will review some of my learnings of reading this book Coffee Can Investing by Saurabh Mukherjee. Coffee Can Investing, the name of this book was inspired by this 1984 paper by Robert Kirby. You can Google this Coffee Can Portfolio Robert Kirby and you'll get the link to the PDF. But basically, in during 1980s, in the US, people used to get physical certificates for stocks that they used to buy, and people used to hide those certificates into a coffee can and forget about it. And what they found is, after a few years, that most of those companies had really appreciated their share price in a significant way. The fact that the person forgot and never looked at it was the biggest reason. And the theory of this paper is that you can make more money being passively active than actively passive. The key summary of this book is if you invest for a long period of time, so now if you are passively active, and if you invest in high quality companies, this is the key, high quality companies, and higher weightage on high quality small caps, also large caps, but while not paying too much in fees. This is the most important factor. Fees and avoiding investment traps of real estate and gold should lead to significant and sustainable wealth creation. So that is the key summary of this book. The big learnings is fees, how much we end up paying in fees, how much we can get by just picking companies that are really good. Those could be big cap companies that over time perform really well. And if we forget about it and not put in a lot of money in real estate and gold, then we have an opportunity to make sizable return. The book starts off with two different clients scenarios and tells us how important it is to get a financial advisor because they can help you with identifying some of the goals and getting clarity and quantifying some of those goals so that you could build the right asset allocation for your goals. And the goals would primarily fit into three different areas: security, stability, and ambitions. During industrial age, people focused mainly on security. Food, clothing, shelter was the key term, and then stability with service industry, and now with ambitions with knowledge industry. And so different goals people have for protection, for standard of living, for wealth creation, and mobility. So the financial advisor has a very important role and helps you clarify the right goals and allows you to get quantification of those goals. But there are five key mistakes that the investors make according to some of the observation of Saurabh. That there's no clear investment objectives. A lot of people don't have that. People also time the market and then they trade too much. Then there's lack of diversification. They think real estate is a good diversification. That's not, because in the US, for example, the real estate is 70 to 80%, 78% correlated to the stock market. So it's not really a diversification. People forget that there is tax implications of trading, of short-term taxes, long-term tax implications. They forget inflation. They pay too much in fees, and then they chase risky short-term returns because of greed. So that is the most important learning, which is there are five mistakes that we should avoid. Then the central concept of this book is return on capital employed, ROCE. There's a key focus of making sure that the portfolio that we select is generating at least 50% consistent ROCE over the last 10 years. If the company doesn't have a return on capital employed greater than 15%, it doesn't fall into the coffee can portfolio bar. There's also a good talk by Warren Buffett on what he views gold investments as and how he thinks it's probably the worst investment ever. And so it's very important to not adhere to this age old wisdom of investing heavily in fixed deposit, real estate, and gold. And we can see through this chart that in the Indian context and also in the US, that gold, fixed deposit, and real estate have not really performed compared to the stock market. So, coffee can portfolio is one which is of a large cap, return on capital invested, employed greater than 15%, sales of greater than 10% growth over the last 10 years. That's the key summary of what is a coffee can portfolio. And what we've seen is that the coffee can portfolio will generate greater than 0% return. So positive returns with 95% confidence when you can hold it for at least 3 years. And about 9 to 10% return when you hold it for 5 years. But on an average, you get like 24% consistent return. So that's the key takeaway of using this. And so this graph also summarizes the holding periods. If you are ready for 3 years plus, then the probability of you losing money is very little. Also, the alpha squeeze of the active funds is happening also now in India. So paying a lot of fees is probably not a good idea, especially if a broker suggests funds to an investor. It's a conflict of interest in some way. There's a lot of fees that happen that the investors are not aware of: transaction fees, annual account maintenance fees, demat account, and whole host of bank accounts that you maintain, hidden distributor fees. There's like so many such fees that go on. And so, like our investments compound, even our fees compound. In the US, there's a huge shift towards passive index funds, and that's also happening now in India. And so the alpha in the fund manager's advantage of beating the index is actually being squeezed, especially in India now that banks are also pushing for direct scheme investments into mutual funds. And things like Nifty Bs are like really cheap way to own the top companies in India. And so it's a very difficult spot for actively managed funds who actually don't have any edge over the long period of time compared to a very low cost fund like Nifty Bs. Even the direct funds are expected to be around 50% asset under management by 2021, especially because of the push by the banks in India. But still, in India, the participation is very low. Real estate is about 77%, financial assets only 5%, gold 11%, durable goods 7%. So very little participation in India, even still in equity. Now, US real estate and Dow Jones comparison on the left is also quite evident as to how real estate is a pretty big trap. Indian real estate affordability index on the right shows clearly, based on affordability per price per square meter, is like really high in India. So you cannot really afford, but in other countries it's comparatively much lower. Also, diversification is not in the United States. It's American stock market is 78% correlated with the stock market with the real estate. So diversification is not going to happen with real estate. So on the contrary, if you add bonds to your portfolio, it reduces your risk significantly without the proportional reduction in return. So it's quite important to educate ourselves on the impact of real estate. Typically, in this book, he goes as far as saying that you can make more money in fixed deposit as compared to real estate, and I find this to be really true. Um, India did have a very big bull run from 2003 to 2013 in real estate. That 10-year period was huge. But after that, the price in residential areas of real estate has been in bubble territory and almost out of bounds. Take a look at some of these cities on the years of existing inventory as of 2017. It's many years of existing inventories still piled up. So it seems to be in a very bad spot right now. Also, one thing that is found is greater than a 1 year holding period seems to be on a higher probability chance of actually making money. And patience premium was a new concept that I found out. Greater than 10 years, the return expectation are much higher than if it is 1 year, 3 year, 5 year, 7 year. And as we can see, the investor is not really rewarded much for holding either 1 year, even up till 7 years. The 10% is still the same. So it reduces to 3 years and 5 year period. But after the 7 year mark, and especially the 10 year mark, the patience premium is much higher. One other thing is the small cap companies. They outperform large cap, but a few lines that I read in this book said over the really long term, like 20 plus years, that's not true. And so small caps do outperform when it is less than 7 years period. So it's very important to know where you're investing in. The patience premium, as you can see, it grows. The standard deviation of making money and return actually decreases, and then it increases in the year period. So that was quite a learning as to how the investor is not really rewarded for either 1 year or 7 years, but after that the patient premium actually comes in and kicks in. So really good learning on what this is. And then the second part is the quality premium. If you have a patience premium and also now add to it good quality companies, then you definitely will consistently beat the Sensex on a healthy margin. That was the key learning from this book. If you add the patience premium and the quality premium on top, then you'll get this magical place where you will have a consistently really high return from your investments, to such an extent that over 10 years the probability of losing money is only minus 3% yearly, but after that you will make like 21% consistently. So really good numbers in this book that I've skipped in a pretty big way. So I'm briefly summarizing. The book has a lot of details on the art of scaling as to how some of these small caps are really hungry to get big, but they fail. A lot of them fail because they cannot scale, they cannot put in the right management in place, that there are so many issues happening with diversification of the businesses, that the small companies can't make it. And there's a huge push from the government as well, like demonetization got a lot of black money out from the system. There's also real estate regulatory act, which enforces a lot of money is actually used for development. GST has a huge impact on reducing tax evasion and black money, and some of these money will come back to the Indian stock market. Um, and so it's quite important to, but also keep in mind that the percentage is still like very, very low, like 5%, as shown in this graph. So patience premium and quality premium seems to be the key learning from this book. They also give a financial planning model Excel document, which can be found at ambit.co/fp, ambit fpxlsm. It's a pretty good freely available model that they have provided, which you can put in your details and it'll give you like your current portfolio, life goals, and then it'll tell you like what percentage returns will you make. So it's a pretty good freely available Excel document that's provided by this book. And then the output will be a sample portfolio of asset allocation. Once you talk to your financial advisor, it'll be a 20% of large cap and coffee can portfolio, good and clean portfolio, which is another tactic that's used and described in the book. Short-term debt. This is the output that your financial planner will help you with. And the key learning is some of these coffee can companies, like in this case HDFC, the histogram of actually positive returns far outweigh the negative returns, which is what, if you add many of such companies, then you are in a pretty good advantage of making long-term money with low risks. So that's the key learning from this book, which is, can you have a low risk way of making money and high rewards? And if you add the patience premium with the quality premium, avoid the investment traps, then I think we've got the magical formula. Before I end with some of these two quotes, again, I will summarize. Investing for long period of time, high quality companies, higher weightage to quality small caps with some professional guidance, and not picking fewer small caps but many small caps, while not paying too much in fees, avoiding investment traps like real estate and gold, should lead to significant sustained wealth creation. So I've gone through very, very quickly, but the book is pretty amazing. I would highly, highly encourage you buy this book and read it cover to cover. Saurabh has done a fantastic job. And I'll leave you with this quote from the book. An investment in knowledge pays the best interest. Be aware of little expenses. A small leak will sink a great ship. So that's Coffee Can Investing by Saurabh Mukherjee. Excellent read. Highly, highly recommend. Thanks.